Hey traders, this is Blake Morrow with Trader Summit, and with me today I have Mr. Richard Matthews from Pardus FX and Mr. Michael Brown. He is from TraderX. Good to see you, gentlemen. How are you?
I'm
Good.
very well, Blake. Slightly warm in the city today, hence the lack of a tie. Dick is putting me to shame there down on the south coast.
I was going to say usually you have a tie on, you have a suit, you're wearing, you're completely decked out, but today
I
you
know
look like
there
you should
there
be
is
on a
a tie
beach.
here. Would you like me to put it on? Would that please your audience if
Please
I
don't
put
make
it
me
on?
look bad. We're good to go. Hey, listen, I'm glad I get to catch up with you guys because we just got the first piece of data that really is kind of kicking off a week full of economic data that's going to move the markets, and also we got three major central banks and other central banks that are meeting too this week, but obviously tomorrow we're going to kick it off with the Fed. So first of all, I'd love to get your views, and let's start off with you, Michael. What are your views with the CPI data? Has it changed at all your thought process on how you're viewing the FOMC going into tomorrow?
Well, in a word, no. I think apart from the headline number coming in a little bit cooler than expected, everything was pretty much bang in line. I think the big takeaway from CPI is not necessarily what it does to the Fed. I think this is something Dick and I were talking about earlier, and it's this divergence that we're seeing between headline prices, and this is in the US. We've got it here in the UK. We've got it in the Eurozone as well, where headline prices are coming lower as energy prices fall and food prices come down a little bit as well. When you take those out of the measure and you look at just core prices, that's staying at a relatively elevated level, 5.3% in the US, almost 7% here in the UK. And I think when you then think, not necessarily in the context of what the Fed do this week, but in the context of what the Fed do in the longer term, if you see core inflation staying where it is, quite frankly, it doesn't matter where the headline number goes. Rates are going to have to remain in quite restrictive territory.
Yeah, that makes a lot of sense, and I think that's we can talk about like the equity market dislocation or thought process as we go into the FOMC, but I think that's where the market right now just still assumes there is going to be at some point the Fed is going to have to start lowering rates, and probably more sooner rather than later. But Richard, what was your takeaway from the CPI today?
Well, obviously, I spoke to Michael about it, and pretty much the same. The core is sticky in the States, it's sticky over here and in Europe, and it's proving really, really stubborn to cut down. And I thought it was interesting that the market's only giving a 5% chance of a hike tomorrow. I actually think they are going to hike, because I think if they don't, they send out the wrong message. And the stock markets are exuberant. And everyone, oh, great, we've beaten inflation. You just said they're going to start dropping rates, which, again, I don't agree with. And then we're going to have high for a long, long time. And I'm talking about years, not weeks or months. So I think they're going to hike again, and they're just going to try and take some exuberance out.
That's I hear what you're saying, and one of the problems I think the Fed has right now is that they are seeing stocks hit highs for the year. Financial conditions are not tightening, they're loosening, and this is going to be a problem and an inflationary problem moving forward. So I get exactly what you're saying, so you see an outside chance that the Fed could raise it. Well, actually, you just said you think they are going to raise rates.
Yeah.
So
Yeah.
oh, wow. Well, that is a place to make the call, Mr. Matthews. So I'm glad that you're here, and I'm glad that you get to make it. So let's talk a little bit about the reactionary portion of the FOMC. Michael, if you're right and the Fed, maybe pauses, how do you think that the equity markets are going to react from here? How's the dollar going to react from here, in your view?
Yeah, well, firstly, let me say I disagree with Dick. I think there's no chance that they hike tomorrow. I think the inflation data today was the kind of final nail in that coffin. Headline CPI coming down to 4%. A slight downside surprise there. I don't think there's any real case particularly given the guidance that they've given around the skip or the pause. I don't think they can now come out and hike and maintain their credibility. I think what I'm looking at over the Fed tomorrow is a couple of things. Firstly, it's the statement. I don't think the statement is going to have any real major changes in it compared to what we saw at the May meeting, maintaining this tightening bias, but a data dependent tightening bias. The other thing is obviously Powell's press conference. And I think, you know, the fact that equities are where they are means that the balance of risks is towards Powell being more hawkish in that press conference. Again, I think he'll rule out cuts this year. I think he'll stress that flexibility that if they do see the economy remaining strong, if they do see inflation remaining persistent, then they're not going to be afraid to tighten again. And that feeds into the last point I want to make, which is on the dot plot, because we get the latest set of dots tomorrow. And I do think we are going to see that, or today when this video goes out, of course, I do think we are going to see that median dot for 2023 move at least 25 basis points higher. It's only going to take, I think, 3 or 4 policymakers revising their estimate for that median to move higher. And I think that's going to be the signal to markets that this is a skip, not a pause. We're not at the end. We're going to just take a breath, see how this is affecting the economy, and then potentially raise rates further. And I think if you see that, we might get a knee-jerk move higher in the dollar, which I'd be tempted to buy into. We'd probably get a knee-jerk move lower in equities. Again, that's a dip that I would look to buy because I'm quite bullish on stocks at the moment.
Okay, well, so you're quite bullish on stocks, but it sounds like you would be buying the dollar too on a dip.
Yeah, I would be. I mean, I think, you know, we'll get on to other economies later on, but, you know, you look at the catastrophic data we had out of the UK this morning. I mean, that just kind of sums up the argument really, without raising Dick's blood pressure too much. You know, what else would you buy in the G10FX at the moment if it's not the dollar? That's kind of the question that I'm asking myself.
All right. Well, Richard, what do you think as far as how the FOMC is going to, or how the market is going to respond in your scenario? So let's say you're right, and that outside chance comes true. The Fed actually raises rates, and the market has to reprice. How are they going to reprice it, and what does that look like in your mind?
I think the dollar would get seriously bought, and equities would tumble pretty rapidly. And just coming back, you know, I do agree. It's a real outside chance that they do hike, but whatever, they're going to come out very, very hawkishly, even if they do skip. Because the danger is that people see a pause and they turn pause into pivot. Rates are going to come down. Whoopee, we're off to the races. Inflation's beaten. It ain't beaten. It's still 2.5 times or 2 times the Fed's target. It's not beaten. And yeah, I know that Michael's going to yawn and go on about when I was in the war and blah, blah, blah. But I remember way back when I was younger in the 70s and the 80s.
During the era of black and white television and rationing.
Yeah. New and short trousers. And inflation gets ingrained in people's thought process. And until it's beaten, they go, oh, I'll get that now because I'm not sure I can afford it next year because inflation's there. I think it takes a long time to get this out of people's heads, longer than it actually probably shows in the data. And just one other thing on the dot plot, I wish they'd just get rid of the bloody thing.
well, Dick, I gotta kind of confront you on that though, because if you look at what the Bank of Canada did this last week and the RBA, don't you think investors now have seen that and said, okay, look, central banks aren't looking to pivot. It's just a skip now. So the skip is more of the thought process of investors, as long as the economic data doesn't tumble. Obviously, if economic data starts to tumble, you start to see an earnings recession and you see economic data just turn south. Maybe the Fed has to pivot, and every central bank would pivot in that situation. But don't you think people are over the idea of a pivot?
I'm not convinced they are. And actually, why, if earnings started to drop and we started to hit a recession, why would the Fed have to drop rates? We've lived in this ridiculous world for the last 10 years of 0 interest rates. Let's get back to normality. Interest rates of 4 and 5% are here to stay. And we've gone back properly to a proper economy. And if you have to take some deadwood out, which has been supported for the last 10 or 15 years by 0 interest rates, so be it, because it has to go sooner or later, and the economy will be healthier afterwards.
All right. Well, some great thoughts from both of you guys regarding the Fed, but let's talk a little bit about the European Central Bank. We have the ECB obviously on Thursday, so which is great. gives us a lot of volatility for those of us in the markets, whether you're in FX, you're trading equities, lots to think about. And Richard, let's start off with you, because I know Michael's got probably a whole earful regarding the ECB. But let's start with let's start.
I was going to say, I'm. This is the first ECB decision in ages I'm looking forward to, because I won't be at my desk for it, and I can't wait.
Well, you know it's going to be fireworks. You know it's going to be fireworks, right? So,
well, actually, Michael and I are having lunch on Thursday together. So.
Oh wow, okay. Well, let's start off, and I can't wait to. I would not want to be at lunch with you guys, not being in the markets, knowing that you guys are going to be on your phones the entire time. So, Dick, let's start with you. ECB. You know, they're obviously going to raise rates, but how's the euro going to respond, and what's their path forward with the ECB?
Yeah, I mean, without a doubt, they'll raise by 25, and I think they'll probably raise again come the end of the summer in September. I think Europe is in a recession. I think the problem, and it's only in Europe, it's also a problem here and potentially in the States, that we've got stagflation, that you've got stagnant, if not recessionary economies, and you've still got inflation. And what do you do in that case? What's the more important thing? Knock out inflation or help the recession? To me, they've got to take out inflation. And Germany's a really interesting case in point, because they've still got quite high inflation there, and they're in a recession. And Germans, for historical reasons, and I think I can quote historical reason when it comes to Germany and inflation, are particularly nervous about high inflation. So, it's a problem. And I think the ECB will continue tightening. I think the one in September might be the last move that they make. What the euro does is secondary to what the Fed does. Okay. So, being a coward and dodging the question, the dollar dominates.
All right. Well, let's ask Michael. I know you're not going to be in front of your computer first time in forever. For the ECB, what are your thoughts about are you looking at the Christine Lagarde TAN indicator as well? How are you reading the ECB?
Well, I think we need to look at the Dick Matthews TAN indicators going on there. He's looking like a rhubarb today. I don't quite know what's going on there. Yeah, ECB, I think Dick's pretty much nailed it. I think we get 25 on Thursday. And again, very similar to the Fed, I think it's going to be almost a carbon copy of the statement and the guidance and the presser from the last meeting. Lagarde was actually surprisingly hawkish when she spoke recently, saying that there's no sign underlying inflation has peaked, which I thought was quite surprising, given that actually core CPI has started to roll over and looks like it's doing so a bit more convincingly now. I do think they go again in July. They probably won't pre-commit to it, but I think we all know they're going to go. I think the ECB gets interesting after the summer, because I think September you're going to have this real battle going on where you've got the hawks on the governing council, the Germans, the Dutch, the Northern Europeans, who are probably at that point still going to be pushing for further increases. But it's going to come at a time when some of the more dovish members are going to be looking to bring that tightening cycle to a close. And of course, after the summer, when we get into September, you've also got the question of the balance sheet on the table once again. The APP reinvestments, they stop in July. What do they do next? And I can see the ECB kind of fudging the September meeting, where they leave rates on hold but accelerate the pace of quantitative tightening to try and keep everyone happy, but in the process actually please no one. But I think Dick's absolutely right. I think that what the Fed do tomorrow evening and what Jay Powell has to say, I think that's going to set the tone for the dollar and for G10FX for the next kind of 6 or 7 weeks. Really, I don't think whatever the ECB do is going to have much of an impact until we get to those sort of slightly spicier decisions where the market's pricing them as a little bit more of a coin flip after as we move into Q3, I should say.
All right. Well, the ECB, I think getting from both of you, it's going to be more or less secondary. I want to just ask you about Japan, and I know Richard, you don't really follow the BOJ all that closely, but you may have some comments here. But Michael, I know you do. Do you have any thoughts about the BOJ? Because we've gotten comments from, Ueda. Seems like we're still, this is not the meeting where you're going to see a policy change from what I can gather. Do you see anything different, and do you feel any different?
Well, this is the thing with the BOJ. I don't think you can ever be sure. I mean, we would have probably sat here in December 2020 and gone, December 2022 and gone, this isn't the meeting where they're going to get a policy change, and bang, all of a sudden they widen their yield curve control band. So it does kind of feel with the BOJ that if you're not expecting something to happen, then they're going to surprise you in a hawkish way. But I would tend to agree. I think, everything we've heard from Ueda since he's taken the job has been almost kind of continuity corroder, very dovish, very cautious, very slow exit from this kind of decades of ultra loose monetary policy. I was actually talking with some clients earlier, but before we jumped on to do this recording, and I was saying that the thing with the BOJ is we all know what they're going to do. We all know that they're going to widen the yield curve bands around the 10-year, then they're probably going to bring it into the 5-year, and then they're going to raise rates. The question is, we don't know when they start that process, and we don't know the gaps between each stage in that process. And I think that's something that markets are still trying to get some clarity on. But, this will probably be famous last words clipped up on Twitter by Friday morning. I'm not expecting much from the BOJ. I don't think there's going to be that many fireworks. And again, I think the yen is just going to trade in line with treasuries as we've seen it done for the last kind of 3 or 4 weeks.
All right. Well, Richard, did you have anything you wanted to add to that?
I just think they might lay the groundwork to start switching yield curve control to come into 5-year from 10 years. But they do take forever to do anything. So they might just sort of lay the groundwork to do that. And to me, everywhere else is hiking rates. It's very hard to buy the yen.
Yeah, sure is.
And
all right. Well,
sorry, I was just going to make one
go ahead.
More point on the BOJ. This is something we're all guilty of, is when a central bank puts out a statement and we all overanalyze and we look at one word that's changed the order of a sentence. Does it mean something? Is it a hint? Most of the time it's not. It's probably the bloke who wrote it got bored of writing the same thing and chose to spice it up a little bit. But I think this is more the case with the BOJ than anywhere else, because as Dick said, they move so slowly and they've been doing the same thing for so long that even one word changing in their statement could cause quite a significant reaction, particularly when you look at, I've just called up rates pricing on Bloomberg here, the market pricing, no chance of any move at this meeting or the following meeting or the September meeting. If you look at yen volatility, that's pretty much on the floor as well at the bottom of its 1-year range. So, it's just those subtle things that in a market that's kind of trading the way it is at the moment could cause more of an outsized reaction than you'd otherwise expect.
That is a great point. Okay, and with that being said, let's just wrap it up with Dick. What's your trade right now? We're on the Trader Summit. Give us your best idea. What are you thinking?
$5.
$5.
Wear diamonds.
Buy dollars, wear diamonds. Gosh, you're old school. I love it. Michael, and by the way, Dick, do you have any specific way you'd like to play dollars on the long side?
Actually, having just said that, I'd probably sell the yen against it.
Okay. All right. Playing dollar yen on the long side. Michael, what are you thinking?
I'm going to give you 2 because I'm feeling generous. One is to be long equities. If we get any dips in the equity market, I'd be scooping those up. As long as we're above kind of 43.25, even down to 4,200 in the S&P. And the second one is, and this will come as no surprise to Dick, I'm sure, is to short cable. You can use the recent high at 26.80, put a stop in just above that, but cable trading north of 126 is just absolutely illogical in my mind. It doesn't belong here. There's nothing supporting it here. We've got the BOE next week. They'll make a pig's ear of it. Sell the hell out of it.
It sure is looking real. I mean, it's been really perky as of late. I've
got to say I agree with Michael, but I know if I said that, I'd just be accused of being a broken record. What do you do for a living? I sell cable. It's just an absolute shower of something, as I put it.
Well, gentlemen, I love your thoughts, love your ideas, and I really appreciate here at the Trader Summit. Michael, what's the best way for our traders to follow your work? I know you've got a great show. It's second to this other show that's out of Australia, but I know you got a great show going on. Tell us a little bit about how we can follow your work.
Yeah, second to the other show that I don't get invited on when the regular hosts are away. Words will be had if Mr. Weston is watching. Yeah, traderx.com if you want to watch some of the stuff we're putting out. Blake is on there as well, and so is Dick, actually. He's recording something with us a little bit later on tomorrow. Or LinkedIn, Twitter, Mr. M. Brown. If you want to listen to my rants during central bank press conferences, then give me a follow there.
Love it. How about you, Mr. Matthews?
You can follow me on Twitter, which is at Dickie Matthews, or I'm on LinkedIn under Richard Matthews, Pardus FX, and you can hear me rant about our wonderful governor, Andrew Bailey. And on that note, before I go even redder and I explode, I wish you all a good day.
All right. Well, hey, you know, I know it's late in the evening for you guys. Michael, I'm not sure what you're still doing at the office, but you should get out and go grab a pint. And Richard, I'm so happy that you got off the train and stepped into your home office to do this with us. So we do appreciate both.
And put a tie on as well.
Yeah.
Yeah. And the tie's still
Actually,
on. Yeah.
It's true. I've been wearing a polo shirt all day. I'm going to wear a different tie tomorrow.
Thank you so much for joining us. Good luck the rest of the week, and make sure you hit a thumbs up for these gentlemen down below if you're watching us on YouTube, and also subscribe to the channel so you don't miss this content. So thank you, gents. We'll catch you on the flip side.
Cheers, Blake.
Cheers, Blake. Cheers, Michael.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.